So anybody who's living under the illusion that interest rates are set by free markets or some mythical unicorns called bond vigilantes should go back to sniffing glue, because that's not how it works. How it works is you have this strong arm, which is not visible to most people because it's the Exchange Stabilization Fund. And to most market participants, they view it as the Fed, because the Fed is the broker that's disseminating the orders, and it looks like the Fed. You see, and the Treasury's happy with that because it makes the whole illusion that America is solvent and that the dollar is strong and that the US bond market has depth and liquidity. You see, the real reality, the US Treasury can compel banks to be risk-free buyers of their debt in any amount they wish to sell. And that's the world we live in.
So joining us today on Wall Street Silver is Rob Kirby from KirbyAnalytics.com. Rob, thank you for joining us today.
My pleasure, Ivan. Nice to meet you.
Awesome. So where do you see the outlook for silver and gold within the next year, Rob?
Let's just say I can't put the timeline on it exactly, but ultimately gold and silver will go up the same way cryptocurrencies, and the poster child for cryptocurrencies being Bitcoin. Ultimately, gold and silver will do what Bitcoin has done, go parabolically up.
I think you have a really interesting background, and I think you can bring some clarity as to how and why this will happen. So why don't we talk a little bit about your background and what you've uncovered and what your experience has taught you in terms of the derivative market, and the key players that have an interest in kind of suppressing the prices of precious metals, if you will.
Yeah, well, I guess by way of background, I came out of university in Toronto. I went to York University, and I had an economics degree, an undergrad degree, and I went to work on Bay Street in Canada, which is synonymous with Wall Street in America. And I went to work for a private interdealer broker of foreign exchange and money market instruments. And I landed myself in the early 80s when a very nebulous new product, financial product, was coming to light called interest rate derivatives. And I was very involved at the outset of my career in institutional brokerage. I started off in foreign exchange, and then I went to money markets, and then I got heavily involved in interest rate derivatives. And one of the biggest derivatives houses on the planet was a customer of mine and my firm's, and I learned the derivatives trade due to that. And I came to understand that interest rate derivatives, embodied in them, is a cash U.S. Treasury trade. Mm-hmm. So for instance, if you transact, typically when you transact, for instance, 25 million in a 3-year interest rate swap, there is a cash bond trade involved in doing that swap, where the counterparties exchange bonds. The payer of fixed needs to buy bonds to hedge the trade, because banks are not allowed to take naked interest rate risk. They must hedge. So, for instance, if a 3-year bond is yielding 1%, mm-hmm. The interest rate swap might be 104, maybe 4 basis points over the yield on the Treasury. Well, the speculation that a bank is allowed to take, or the traders that a bank is allowed to take, is the spread between the yield on Treasury and the contract rate on the swap. So they're only taking a bet on the 4 basis points between the yield, the 1% on the bond, and the 104, which would be the contract rate on the swap. So instead of thinking about it as a $25 million bet at 1.04, think of it really as a $25 million bet on 4 basis points. Mm-hmm. And this exemplifies how basically there's a securities transaction embedded in the swap. So what happens nowadays with the obscene amounts of these things that transact, and with who the silent hand is, because understand, these things have proliferated to the point where you have many hundreds of trillions of these things that transact.
I mean, is it fair to say that this is just a giant house of cards with these derivatives?
Yes. It's a Ponzi game.
And who are the big players in this?
Well, you've got the banks, which effectively are the agents for the U.S. Treasury. The Treasury is the ultimate issuer of the debt. I mean, it's the Treasury who needs the funding, who issues the debt, and the broker for the U.S. Treasury is the New York Federal Reserve Trading Desk. So to the layperson, it looks like the Fed is involved in these transactions. But understand, they're only involved as an agent, as a broker. You see, I was a broker between banks. So my job would be to connect Citibank Canada with Mitsubishi Bank Tokyo, or with Standard and Chartered Bank London. So
basically the Fed's a broker.
Yeah. So, well, no, we weren't the Fed's broker.
No, I said the Fed is acting as a broker, you said.
Yeah, no, the Fed acts as a broker for the Treasury.
Okay.
So when the Treasury, understand the Treasury is the ultimate issuer of all the debt, and it's the Treasury through their Exchange Stabilization Fund, a secretive adjunct of the U.S. Treasury created in 1934, and it's this entity that effectively implements U.S. monetary policy via their agent, the New York Federal Reserve, who disseminates the orders from the Treasury, specifically the Exchange Stabilization Fund of the U.S. Treasury. They disseminate those orders to the commercial banks and the bank holding companies, which basically bullies or drives U.S. monetary policy, making interest rates typically to make them go down. And because what it does is using these interest rate derivatives, they create synthetic demand for U.S. government treasuries. And because, as I said, when banks deal in the interbank market, they don't take naked interest rate risk. The Exchange Stabilization Fund or the U.S. Treasury, they do take naked interest rate risk. And that's what compels the other side of the trade to be a cash buyer of U.S. government treasuries in virtually any amount they wish to issue.
So, I mean, is it fair to say that they're just pulling money out of the sky here with this?
Yeah, well, at the same time, think about it this way. If we go back to the last quarter of 2019, and then go from the end of 2019 to the end of the first quarter of 2020. Remember that 2020 is when COVID reared its head, and the economies around the world took a beating. The yield on the 10-year Treasury at the end of 2019 was 1.80. At the end of the first quarter of 2020, the yield on the 10-year Treasury was 60 basis points. What happened in those 3 months? The outstanding aggregates of derivatives held by U.S. banking institutions went up by 40 trillion.
Wow.
Okay?
So basically,
40 trillion in interest rate derivatives drove the 10-year government bond from a yield of 180 down to 60 basis points.
Is it fair to say that the Treasury kind of forced the hand of these banks to buy these derivatives? Or
yes,
okay.
they compelled them to be risk-free buyers of 10-year government Treasury product, driving rates from 180 down to 60. So anybody who's living under the illusion that interest rates are set by free markets or some mythical unicorns called bond vigilantes should go back to sniffing glue, because that's not how it works. How it works is you have this strong arm, which is not visible to most people because it's the Exchange Stabilization Fund. And to most market participants, they view it as the Fed, because the Fed is the broker that's disseminating the orders, and it looks like the Fed. You see, and the Treasury's happy with that because it makes the whole illusion that America is solvent and that the dollar is strong and that the US bond market has depth and liquidity. You see, the real reality, the US Treasury can compel banks to be risk-free buyers of their debt in any amount they wish to sell.
Wow.
And that's the world we live in.
Can we extend this over to the COMEX? Do you believe that the Treasury is also manipulating the price?
Well, listen, the price of precious metals is heavily suppressed. Okay, I mean, I've been a consultant with GATA for many years.
Oh, really?
I know the GATA line very well, and I know the people at GATA, and I mean, they speak truth. And I mean, precious metals prices are heavily suppressed. But let me tell you this: suppressing interest rates and suppressing the nominal price of precious metals is a very expensive undertaking. And to do that, there are very few entities on the planet that have the heft or the resources or the motive to suppress precious metals or basically suppress interest rates. And to a point, that basically identifies who the culprit is, namely it's the Treasury itself. And isn't it funny? The world's biggest debtor effectively controls the rate it pays on that debt.
So, you know, when I used to be a trader, a lot of people would talk about the plunge protection team.
Yep.
They would come in, like, you know, the market should be collapsing, and all of a sudden, I mean, this was during the Greenspan days. Yep. So do you believe the Fed is actually buying into the equities market to stabilize that as well? Or do
Absolutely
you think...
they are. Okay. Sure they are. Yeah.
Now,
see,
go ahead.
I collaborate with and am a huge believer in the work of Dr. Mark Skidmore and Catherine Austin Fitts. And they've done work showing that there are many trillions of dollars that have basically disappeared into the ether. Skidmore's subsequent work, which he's followed up on, and I understand this is after the federal government took most of its financial books dark, with the institution of FASB 56, which basically acknowledges and states very clearly that the U.S. government is allowed to keep two sets of books.
So if I'm hearing you correctly, the government basically is printing money out of thin air.
Yeah.
They're using the Fed to kind of broker deals to force these banks to play along. They're driving down the interest rates, and they're also suppressing the precious metals market, and also they're keeping the equity market afloat.
Yes.
And when that game stops, everything collapses.
Sure. But listen, if you want to keep the equity markets afloat, zero interest rates is a great way to do it. So I ask you this question. If we had interest rates at 14% right now, do you think the stock market would be where it is?
No.
Right. So when does this game end?
The game ends when there is absolute rejection of the US dollar in trade settlement globally. And we're well underway to that happening. Because countries around the world are moving away from the dollar in trade settlement.
Yeah.
I mean, listen, here's an interesting thing. The cryptoverse, the daily turnover in the last few weeks has been about 110 billion a day.
Wow.
Annualize that and tell me how much trade there is in crypto. You got a number around 36 to 40, low 40s trillion in turnover in cryptocurrencies. Do you not believe for a minute that there's trade settlement occurring in cryptos?
Well, what's your take on this World Economic Forum and the Great Reset? I mean, and the International Monetary Fund. From my perspective, it looks like they're going to just take what has been going on with the Fed and just making it a global system for everybody.
Okay, well, there we have to expand. We have to expand our discussion into globalism versus humanity, and what has shaped up here. I mean, to begin with, anybody who thinks that the monetary levers or the monetary might and the military might, if anyone really thinks it's controlled by Americans for Americans, think again. America is captive to a group of elitists called globalists, and these globalists have it in for humanity. The globalists have written white papers going back 20, 30 years where they have advocated for the reduction of global population to 500 million, which is a number maybe they pulled out of a hat or maybe out of some dark orifice on their body. And this is what they believe is sustainable for the human population going forward. And these people are behind the likes of and are symbolized and fronted by the likes of Klaus Schwab, this pig dog who runs around telling us we'll own nothing and we'll all love it and be happy. Dead people don't point fingers. And they don't want people pointing fingers at them for the atrocities that they have leveled on humanity.
Yeah.
And let me tell you something. What's been done with our financial system and with our capital markets is a crime against humanity. Plain and simple.
Would you ever classify the economic system we've been living under as capitalism?
No. It ceased to be capitalism. You see, I worked on a trading desk in 1987 when the stock market collapsed. And shortly after that collapse, we had the creation of what's called the Plunge Protection Team. And formally, it's known as the President's Working Group on Capital Markets. And the reason it was formed is because it was nearly lights out for the Western world. The entire global banking system very nearly collapsed in October of '87. And basically what they said is we're never going to allow that to happen again, because basically the globalists were in control then and basically fulfill their wet dream. I mean, the wet dream of globalists: one world currency, one world government, and one world religion, which is namely the worship of state. And that's where we're headed.
Rob, we want to thank you so much for coming to Wall Street Silver. Like
you're an absolute wealth of information, and we're going to have to get you back because there's no way we can even touch on what you've been talking about.
I just know too much stuff because I've been there and done.
Yep, I get it.
Thank you so much, Rob. We really appreciate you for coming to Wall Street Silver.
Been my pleasure, guys.
Hopefully, we'll have you back in a couple months.
Yes, please.
Hopefully we're all alive to talk about it.
Awesome. Take care, everyone.
Take care.